All right, so I'll just do the usual. I'll just kind of talk about the market environment and what we see going into this week and some of the stuff that we're expecting, some craziness going on, and I can briefly talk just some of the areas that I'm looking at in terms of trading and what to look at, but and then we can go through some of your guys' plays and what you've been looking at, what else is going on. But with the market, I mean, we had a nice little drop, nice little drop after the minutes. I mean, it wasn't that surprising in terms of minutes for a lot of people. I think the biggest concern from the minutes on Wednesday obviously was the accelerated accelerated rate hikes along with a more aggressive balance sheet runoff. Those are two things that are it just adds way too much fuel to the fire in a lot of people's opinions, and they could do one without the other. Preferably, a lot of people would probably prefer them to offload some shrink their balance sheet and ease up on rate hikes. But we'll see what happens with the good, quote unquote, good jobs print we got on Friday. It'll probably keep them on pace to do what they want to do with rate hikes. And March right now is being priced in as the highest likelihood to see rate hikes from the Fed. The Friday jobs report was top line was abysmal. It was absolutely abysmal, but the household survey came in good. And there's a difference. So I want to pull up I have just a couple of the key differences here between the two. The household survey includes people on unpaid leave among the employed, while the establishment does not. Household survey includes agricultural workers, self-employed workers, unpaid family workers, and private household workers. The household survey also has no duplication of individuals because each individuals only count once, even if they hold more than one job. So there's differences between the numbers, but that's, I believe, what the unemployment is pulled from. And so unemployment dropped pretty decently below Fed's expectations and a lot of people's expectations. Jobs gained was okay. I'm still convinced that this job market is broken. When you've got over 4 million more job openings than unemployed workers, it's going to be very hard to fight wage inflation. You also have labor turnover at the highest it's ever been. Despite unemployment being gone, you just had people voluntarily leave the workforce. So I think that's where the biggest issue is. Now, whether this just becomes the new norm, whether we figure that part out, we'll see. But that's kind of where we're sitting in terms of the jobs market. Jobs market is largely considered back to quote unquote norm, despite a lot of job openings in a very competitive labor market. So the Fed will probably be raising rates. That's why we saw the rates go astronomical last week. We saw them really take off. If I zoom out slightly and go to the beginning of last year, we saw a pretty similar move. This is I'd say moving a little quicker than we did in here. But the first week or two of the year last year we took off, had a little pullback, and then had a very strong February. So February was very strong for rates. And just because rates are rising at a pace like this, the market doesn't necessarily just like implode. This is where we were. It just kind of gets stuck. It gets muddied. It gets a little muddled. It really can't lift off the ground. And this is what the market was doing. It was going up for a lot of it. And if you look at the Qs, which would be more affected by rates, they even still manage to ascend. It just gets a little volatile, a little choppier. So just because rates are going up, it's not like, oh my God, the market's got to implode. But they are things to watch, because rising rates at this velocity is going to be something that we need to continue to watch. Now the yield curve did flatten a little bit. Short end rising faster than the 30-year, than the long end. Makes you think that the bond market might be pricing in policy error, especially if they do decide to go with rate hikes, as well as running off the balance sheet into what could be an economic slowdown, which could then really turn into an economic downturn. So that's just something that we've been monitoring, and we're just going to have to continue to monitor. There's nothing else we can do there. But just kind of watch and see what the bond market says. But other than that, we pulled straight back to the 50-day on the SPY, kind of nestled ourselves in here pretty nicely. We did kind of move a little lower in the after hours, so we'll see where we are by Monday. But if we're down here, I wouldn't be just buying. I wouldn't just be blindly buying. Qs obviously a lot weaker. They got well below their 50-day, and they're sitting on a pretty decent little ledge here. If we break this ledge, which is this low here around this 379 on the Qs, I mean, I could see us going to the 200-day, which is frankly fine. We didn't touch the 200-day all calendar year last year, and that's a rarity in the market since inception. That's something that doesn't often happen where we don't ever touch the 200-day in a year. So we could, we're due to have a pullback. So if we do drop that, great, that's fine. As traders, as short-term traders, it shouldn't matter. You get opportunities in both directions. And even as long-term traders, if someone that has like, long-term investments, don't try to time the market. Just you take some off into strength, have some extra cash to reload and buy. You should be thrilled because you should be able to buy as things get cheaper. IWM's just still in the same old range it's always been in. So there's nothing really to report there. It's the same old, same old. And then in terms of volatility, we obviously expect volatility to be a little more in play this year, especially with how crazy things might get. Obviously, a lot can change, but we saw that volatility primarily in tech. No real surprise. The VXN really rising the most because of the rise in rates, really causing a lot of the big boys to sell off, and that's kind of where the market is. So yesterday, I believe it was, percentage of stocks trading above the 50-day SMA was dropping pretty decently, but percentage of stocks trading above the 100-day SMA, actually one of these days was green while the rest were red. So what you had was people kind of bottom dipping a little bit and catching some of the undervalueds and popping them a little bit. Now the market dropping kind of will eventually drag everything else with it. But stocks below the 200-day aren't really making a new low, so they're not selling everything. They're selling the winners. They're selling the hard winners. Home Depot had a pretty aggressive drop. Costco had a pretty aggressive drop. Lowe's had a pretty aggressive drop. Obviously, Tesla's come off from that squeeze. Microsoft's below its 50-day. Google's approaching its 200-day. So Nvidia obviously below its 50-day. So you have the big boys kind of leaking a little bit of air there. And if these are the stocks that are responsible for the majority of the gains in the market last year, then their weakness is going to drag the market down. That's inevitable based on the amount of weighting they have. But again, not to say that that everything's going down. Financials obviously doing really well with the rise in rates like that. Energy's obviously been doing really well with oil taking off. Some of the other consumer staples doing well. They're holding up. Industrials have been doing relatively well. So a lot of those kind of plays are actually holding up pretty decently. Utilities is doing okay. You're just seeing some of those leading sectors leak. Healthcare getting hit, a lot of those guys. So there's good plays, stocks like Verizon, stocks like Procter and Gamble, PepsiCo, Mondelez, these kind of guys that we always talk about. They're still strong. They've been bottom grabbing stocks like Caterpillar that are underperforming in the sector. Talked about when they ran Intel and MU and underperformers even in that sector. Though we'll see if that can sustain itself. Hell, even Mike's trash Viacom was running like 10% the other day. So this is a serious little run here for a stock that's really been underperforming. So that's what we're seeing right now. Stocks that gap up on news and headlines and try to meme, for the most part, are selling right now. I'd argue. I think from most of the ones I see end up selling off. ABSI sold off. GME obviously sold off, but that I think would have happened regardless. IMMX sold off. MYNZ sold off. JWEL has sold off. GNPX had a nice strong day, but has since sold off. So we're not getting any kind of meme plays follow through yet, but that's not to say any won't. So that's kind of the market. So there's levels to watch. I have no idea where we're going to go to next week. We don't really have anything on Monday. Monday's actually going to be pretty quiet, so it's likely we see low volume. But unless we get ourselves in a gap in either direction, then you could get some stops pushed and you could get a little bit of movement. But in terms of news for next week, we'll have Powell speaking on Tuesday in front of one of the Senate banking committees. That rarely provides anything. But if people could ask them about some of the upcoming policy changes, Wednesday you have CPI 10-year note auction. I am going to be curious about these note auctions. You get the 10-year note auction on Wednesday and the 30-year bond auction on Thursday, and I'm just going to see if that moves the rates at all. If you get a strong auction or not from them. CPI on Wednesday, like I said. Thursday you'll have jobless claims and PPI. And then Friday, you get a couple other numbers: retail sales, import export prices, industrial production, business inventories, consumer sentiment. We're going to start to piece together what the economy looks like. And by the end of the week, we're going to kind of start trickling into earnings. And I think this is going to be an important earnings because this is going to set the stage for, we just had two incredibly scorching hot earnings seasons or earnings quarters, especially for retail and for a lot of sectors like that. So now the question is growth going to slow down? What are how are these companies performing now with Omicron? And did that stifle growth at all? And are there expectations and guidance going down at all in the coming year? So the end of this week we'll have Delta earnings and Taiwan Semiconductor earnings on Thursday, and then you have like Citigroup, J.P. Morgan, and Wells Fargo on Friday, and then you get like it kind of slowly ramps up next week from there. So things are going to start picking up here. It's going to be a very interesting end of the month. I'm excited. It's going to be some good trading. But yeah, I think that's mostly it. Not really any new headlines otherwise. You still have China trying to grapple with a zero COVID policy as well as a slowing economy. And then you've got Kazakhstan still in flames. That's only having a more specific impact in the market, nothing too serious at the moment. And then you've got some other random energy things. In terms of commodities out there, and then we can turn it over. Oil obviously still looks really strong. There's been nothing to slow this down. Growth is still good. Supply hasn't changed. Omicron hasn't touched anything. Going into a cold winter, nothing's helped Europe yet. So oils, I think, will continue. And then gold and dollar, who cares? They haven't been able to really get a move lately. Obviously, Friday it was a little surprising to see the dollar drop to that extent, but we'll see if this is a pullback in the dollar or not. And then finally, crypto, which is still selling. This is why if something looks weak like crypto, where it's trending lower and holding on a ledge here and the market's going risk off, you just got to wait. Now Ethereum is at the 200-day, but I still wouldn't be buying quite yet. I still need to let the dust settle here and see what's going on. And where the dip buying is. Now, some people are arguing that we are oversold. We are a little oversold on RSI. It's kind of coming down to some levels here. But even after we kind of bottomed out in here after this last drop last summer, we still trickled down slightly lower before we rebounded. So just keep that in mind. Ethereum is at the lowest point in the RSI it's been, so we could get a little bit of maybe stabilization this week, but it could be time to watch crypto, but I'm not going to be flooding straight in. So that is it for the markets. Yeah, so